Hi there everyone and welcome to this week's market update. Don't forget that any advice contained within this presentation is general only, so it is entitled to your particular circumstances and you need to decide for yourself whether it's appropriate to you. Okay, so our markets had a stronger session today after a nice reversal signal yesterday and a test of the longer term uptrend line. So right now we're still though trading inside the pennant, okay? We could still hold levels around sort of this resistance at 74 this time around, but I sort of feel coming into Christmas and the strong futures we're seeing at the moment, we'll probably push up closer into 75 by the end of the week. Okay, so around this sort of 75 resistance that we set back here early November. So at this point of time, yeah, it looks like we'll probably drift up towards that 75 between now and Friday. All in all, the long-term uptrend's still intact, although there's been a pretty big breather through here. We have got some early signs of reversal, but still too early signs really to be worried about it at this point. 72 is the level, or 71.80. If that breaks, then we'll start talking about downtrends. But at this point of time, the long-term uptrend line's still in play, and we've just seen a pretty big breather through here. Interesting enough, if XJO closes around these levels, going back to where we started last year, guys, right? We're looking at, a performance of around 10% for the year. So we're sitting at about just under 10% right now. If we go back to 7,500 by the year end, about 11% gain for the year before dividends. So, that's a pretty average normal year. Okay, could have been a lot more, but unlike the US market, we have held back a bit over the last 2 or 3 months. Now, coming across the US markets, they've been quite volatile compared to our sideways market. They've pulled right back, testing the longer term uptrend line. So that was, good reversal last night with the futures up at this stage. We'll likely see a bullish signal like we're seeing on our market now. My prediction for the S&P 500 by year end would be a test of the all-time high once again. Then we'll have to evaluate whether we think it's going to break any higher. But sort of similar patterns as what we're seeing over there to what we're seeing here is that uptrend line is definitely still intact. Higher peaks, higher troughs. Although this is probably one of the longest times we've paused at a resistance level for quite some time. So it's got us questioning. It's you've got that little bit of fear in the back of your mind of whether this is going to break lower. I can't see that happening this side of Christmas or New Year's. It would have to have some pretty bad news around Omicron. Further lockdowns or something to make that big pullback eventuate. So we're definitely seeing a muted Christmas rally this year. We pulled back into the last sort of week before Christmas here. It's always a bit of a mixed bag when the Santa rally really kicks off. Definitely looks like we're kicking it off today. And suspect the next 3 days to be, pretty strong coming into Christmas. If not, we'll push up into the new year. Through this period, it's always low volumes. In those low volume situations, moves can get exaggerated, both to the upside and downside. So it typically can be a little bit volatile in the daily movements, but we don't usually really break outside the range too much either. So, sideways moving strategies using options, works in this environment also. So we're expecting a fairly muted Christmas rally. A few things going on that has caused that. Obviously, the top of the list is the Omicron fears. So there's, I guess, more uncertainty than anything out there around the Omicron variant at this point. Early data suggests that it is less severe than previous variants, but much more contagious. We've got huge cases starting to show up in New South Wales here. I think last time I checked it was about maybe 20 cases of Omicron in Victoria. So it's still very early days for Australians. Here we've got high vaccination numbers as well, but also we're questioning whether we have to go back into lockdown until third doses are reached by many people. So it's just so much uncertainty. One way or the other, we're not going to see any action before the new year. if they're going to lock down borders again or reintroduce any restrictions here in Australia, it's likely to be next year sometime. We've seen no real official notice from any of the state or federal levels that that's going to be the case. So at this point of time, I think the fears are going to go across the sidelines. We'll be watching really how things progress overseas and whether the US go into further lockdowns or not. One way or the other, the overall market probably won't move too much on Omicron in the short term, but what you might see is things like travel stocks and stocks that do well in reopening might hold back a little bit here in the short term. But all in all, we feel that this, we've got vaccines to battle this. In the medium to long term, we still believe that the markets are going to recover and push higher. Okay, the uptrends that we're seeing, or the uptrend we saw over the last few years, the roaring recovery, that's not likely to continue, guys. Right? Any further gains we get from here is going to be really slowly up the staircase, and so we expect next year to see a lot more volatile moves, a lot more corrections, like the 10%, 15% pullbacks we see in markets before they continue higher. So we're going to go back to markets the way they were before COVID. Okay, so we've got to readjust our strategies and the way that we handle and manage our trades. The other bit of news that was interesting was the Federal Reserve last week. They have definitely flagged that they're going to end bond buying by early next year. And then the dot plot is suggesting 2 to 3 interest rate rises next year as well. The biggest problem with the US at the moment is the inflation problem. And a lot of that inflation problem is coming from the supply chain issues. The problem with all of this, so interest rates going up is usually not a negative thing for equities, but when you've got talks of interest rates going up, whilst there's a new variant that is threatening lockdowns in the US, that is causing some problems in the sentiment of the market. These problems in the sentiment of the market are usually short-term in nature. What we're going to have to look out for really for the longer term view is the yield curve. Okay, so the government yields in the US and the government yields here locally in Australia. The interesting thing is what we're seeing with the view of short-term interest rates going up, we're not actually seeing the longer part of the curve go up with it. We're actually seeing the longer part of the curve come down and the shorter part of the curve go up, which is flattening the yield curve. A flat or inverse yield curve is suggesting a recession is coming. So looking at that yield curve now compared to a year ago, what we're seeing is signs that people do not believe the economy will be strong beyond next year or the year after. So interest rates will likely go up and come straight back down again. That's not breathing confidence out there. Okay, so what we're seeing is confidence in the long-term performance of the economy is starting to fall off again. All right, so that comes with less central bank money being pumped in. We've got central banks around the world starting to indicate they're increasing interest rates, and we've still got supply chain issues caused by COVID. So many are predicting that all this helicopter money we've seen, all the money that's been pumped into the economy, that's going to have an effect over the next year. We'll see a reasonable year next year with strong inflation, but then things will probably just go back to the way they were pre-COVID, where we had deflationary problems and the economies were just pretty flat and just not really growing that strongly. So that's what we're seeing from the yield curve at the moment, guys. So what that says to me, what does it mean for equities? Well, equities could still be bullish next year, but things are going to find a top soon. Okay, that's what it's telling me, right? So once again, we will use a combination of fundamental and technical analysis to try and pick where we think the top is, but we've got to go into 2022 with an open mind. The market can move on a dime. The sentiment could be really bullish for quite some time, and then you might very quickly get those flash crashes of 10-15% like we used to get, because there is a lot of uncertainty out there across the longer term landscape. So that's where we're at for 2022, guys. Look, we should be smooth sailing for the next few weeks. There's really not a lot of news to hit markets around the normal reporting and Fed, central banks and things like that. None of that type of news kicks off again until late January. So the only thing that I sort of predict that could upset markets between now and then would be any more news around the Omicron variant and further countries going into lockdown. That's what we'd be looking for over the Christmas period. If all stays quiet, sideways to slightly bullish is the view for now. Alright, so that's where we're at. Thanks for listening in. Take care and bye for now.